Don't invest in the stock market until you watch this Investing in the Stock Market. Risks and benefits. Every investment opportunity brings interesting realities. In every project that involves money, there will always be risks on one side and benefits on the other. Being smart starts with acquiring the right knowledge, and useful knowledge only comes from information. Investing in the stock market, just like any other venture, is both exciting and challenging. If you are new to investments and intend to invest in the stock market, there are important things you need to know even before you start. The amount of information you have will determine how much success you generate. I can tell you that no one takes prisoners in this jungle. The two factors that will determine your success in any investment initiative are risk and rewards. Your goal should always be to reduce risk and increase your reward, but before you can do that, you need to know what the risks are and also what the rewards are. Therefore, you should think about what you can do to bend situations in your favor. The risk factor presents the possibility that you could lose your money. Losing money is a song that no new investor wants to hear. Its sound will send chills down your spine, but if you understand the dangers and how to manage them, then you will be open to receiving the benefits. We will examine the stock market from a general perspective. We will also take a journey from where it all started to where we are now. I can assure you that this is a journey you wouldn't want to miss. Before investing your money in any stock that seems valuable, if it is, do it right away. Go ahead and hit the like button and also subscribe so you can see more videos like this one. Let's continue. What is the stock market? According to Investopedia.com, the stock market refers to the collection of markets and exchanges where regular activities of buying, selling, and issuing shares of publicly traded companies take place. These financial activities are executed through official exchanges or over-the-counter markets. Transactions must operate according to a defined set of regulations. A country can have multiple stock trading venues. In these venues, transactions in stocks and other forms of securities can take place as long as all parties involved adhere to the rules. Definition of some important terms. Stock market and stock exchange. The terms stock market and stock exchange are often used interchangeably, but in reality, a stock exchange is a subset of a stock market. Please do not find these expressions confusing. I will explain them easily. Many people make this difficult to understand, as if it were rocket science, but it is not. Let's pretend we know a certain Miss Veronica who is an investment enthusiast. If she tells us that she trades on the stock exchange, it means she buys stocks and equity securities on one or more exchanges. These exchanges constitute an entire stock market. The major stock exchanges in the United States are the New York Stock Exchange, NYSE, the NASDAQ, and the Chicago Board Options Exchange, CBOE. In the United States, many other exchanges operate, in addition to the three mentioned above, which together form the US stock market. Besides the United States, there are various stock exchanges in different countries, such as the Japan Exchange Group in Japan, the Shanghai Stock Exchange in China, the LSE Group in the UK, the Shenzhen Stock Exchange in China, and BSE India Limited in India. There are many more scattered across many nations of the world. In simple terms, stock markets are public places where people gather to buy and sell stocks, but the progress of technology has made it possible for these exchanges to exist as electronic markets. Starting from today, stocks or shares. A stock or share is a financial instrument that represents a share of ownership in a company. Ownership of shares in a company entitles the shareholder to receive residual income from the company's profits. These payments are made quarterly, semi-annually, or annually and are called dividends. Ownership of shares often entitles the holder to voting rights during the company's corporate meetings. If you own shares in a company, it means you are entitled to a share of that company. If the company decides to split today, what you will receive in the form of money or assets will be directly proportional to the percentage you own in that company. Let's pretend you invested in a company that has a total of 2 million shares in circulation. If the number of shares you own is 200,000, that means you own a 10% share in that company. Note that there are companies whose shares in circulation amount to billions. Brief history of the stock market. The stock market has not always been as structured, organized, and regulated as we have it today. It took centuries of growth in advance to bring the market to this point. The 16th and 17th centuries marked the emergence of the first stock markets in Europe. Trading began in the port cities of Antwerp, Amsterdam, and London. These early centers were in bond markets. The companies involved were few and did not issue stocks. The 18th century marked the beginning of the American stock market. The first stock exchange that was born was the Philadelphia Stock Exchange, PHLX. When the New York Stock Exchange, NYSE, was founded in 1792, it allowed stock shares to be traded. 24 stockbrokers and merchants in New York City gathered to sign what is known as the Buttonwood Agreement. Before this, traders and brokers met under a buttonwood tree on Wall Street to buy and sell stocks. These meetings and previous transactions were not official and were not adequately regulated. Further progress in civilization brought regulation and professionalism to the stock market. Many stock exchanges eventually developed in the United States and around the world. Today, technology has even gone beyond moving trading from these centers to the internet. Some exchanges are electronically linked, and traders can stay in their homes and buy and sell in an organized structure. While there was once an advantage for insiders, the stock market today has become more efficient and more liquid. There is a level playing field for every participant, for the most part, at least. Demand and supply in the stock market. There are so many ways prices of stocks are established on a stock market, but the auction process seems to be the most common. In this process, those who buy and those who sell make bids and asks. Bid. This means the price at which an individual desires to buy the stocks. Ask. This is the price at which a person desires to sell. This is also known as the offer. The person who makes a bid and the person who asks must accept the price for a transaction to take place. Fluctuations in stock prices occur because there are thousands of transactions happening simultaneously. The function of a stock exchange is to provide the platform that connects these individuals who want to sell and investors who want to buy. If you intend to have access to these exchanges, you will need the services of a broker. The broker is the intermediary who stands between the seller and the buyer. It is interesting to note that brokerage has moved from registering with individual brokers in their offices to creating an account with an online retail broker. The law of demand and supply has been an important factor in every economic setup. It is even more obvious in a system that involves millions of people making transactions simultaneously. Here's how the law of demand and supply works in real-time stock trading. When there are more investors showing interest in the stocks of a particular company, the price of those stocks will rise. On the other hand, when more shareholders want to sell the stocks of a company, the price falls. We saw earlier that a transaction can only occur if a buyer accepts the price asked by the seller or if a seller accepts the price offered by the buyers. Now, when buyers are more numerous than sellers, what happens? The buyers will be willing to increase the price of their bid. Look at it from the other side. When sellers are more numerous than buyers, the buyers will lower their bids. Therefore, the sellers will be willing to accept lower offers. So, the price of a stock responds to the laws of demand and supply. What not to do when investing in stocks. 1. Do not be emotionally attached. ***, you must avoid investing in a company because you have a soft spot for that company. Once, I heard the story of a former footballer. Let's call him Mr. John. John grew up playing for the local team of his hometown. His skills developed in this team. With the team, he won many local and regional awards. His best childhood memories were born in this team. Later, bigger clubs noticed his talent and signed him. Eventually, he became a great player and an international star. Money came in, and he retired with so much wealth. Upon retirement, his first investment was to acquire the team of his childhood. He neither properly examined the records nor ordered to get the services of a financial advisor. He invested most of his savings in buying this club because he was fond of it. What happened afterward? He lost his money. He didn't know that the club was in debt up to its neck. He had acquired a liability instead of an asset, so he found himself in a financial disaster. John made this mistake due to his emotional attachment to the club of his childhood. Many people make this type of mistake when investing in the stock market. Some people buy the stocks of a company simply because they like it or because of the emotional stories of the past they have heard about the company. This can be dangerous. 2. Do not invest randomly. **** Buying stocks of a company randomly is the same as gambling. This is what some people do. As ridiculous as it may sound, they do it just to feel like they are investing, but in reality, they are playing with their money. You should invest in a company that has a history of measurable progress. You need to do a background check on the management and its internal practices. The management of some companies cuts corners and may have a long string of legal battles. These people may be dishonest and may have siphoned off some profits, leaving the company vulnerable. They may have hidden most of the risks from the investors. Investing in such a company means you are playing a fortune. Before buying stocks of any company, make sure you understand their records and history. Be convinced of the company's ability to increase its value over time. Remember that you are investing to grow your money, not to lose it. What you should do to get the best reward from your stock investment. 1. Diversify your investment. ***, you should spread your investment across the different levels of the stock market. There are large, medium, and small companies listed. You should take this step only after conducting adequate research on each of the companies you would like to invest in. This will help you combat the market fluctuations. Some stocks will do well while others may not do so well, but diversifying your portfolio will give you enough security to know that at least your investments will be constantly increasing, regardless of what happens. You have probably heard the saying, "Don't put all your eggs in one basket." 2. Invest for the long term. ***, investing for the long term means you are willing to hold your stocks for more than 10 years or more. If you are in a hurry to make profits, you might fall into the trap of these two emotions. These two emotions make people lose money in stock investments and other forms of investment. The emotions of fear and greed have been identified as the main cause of money loss in investments. A fearful person wants to sell as soon as their stocks start to go down. A greedy person wants to buy when the stocks are appreciating. Stocks constantly fluctuate, indices rise and fall, but if you have made the right choice, your money will be safe in the long run. A long-term investment will produce exceptional results regardless of the number of fluctuations that occur along the line. If you liked the free value you got from watching this video, you can get more. Here are some videos you can watch. When is the right time to sell? How to be a good investor? Let us know about your practical experience regarding today's topic by writing it in the comments. And do not hesitate to ask questions, we will respond to the best of our ability. Do not forget to share your opinion with us and leave a comment. If you also leave a like, it would be great. Subscribe so you don't miss the next video.